Well, hello everybody. It is September 30th. This is the weekly review where we take a look at what happened last week, maybe what it tells us about the coming ones. Just look at the markets in general, think about how we should be positioned and what we should be doing. Last week, number-wise, it wasn't that bad. You ended up with, well, actually, small gains, small losses. It was pretty much distributed. Negative on the year, down 5%, down 3.5%, down 8% on the Dow, and still positive here on the Nasdaq. So at best, it's mixed. If you want to look at the glass half empty, you got negative readings, fairly significant across the board at this particular point. As far as what's happening in these markets, let's do a quick review. The big event, of course, last week was the Federal Reserve, what they were going to do and what they did. And what they did was not what I expected. I thought they would find it in their hearts somehow to raise rates to get us off the ZERP, but it was not to be. They gave up and they acquiesced to leave things as they are. The market sold that news, sold back down as a result. And if you look at it from a technical standpoint, we now have neoclassical failures on that bearish retest regenerates on the Nasdaq and the NDX. So let's quickly spike over and take a look at that. And we'll start here with the Nasdaq itself. That bearish retest regenerate, as you probably are quite aware of now, is this area here. And as you can see, we came right into the top of that zone and was unable to get over it. So you came right to the top of that zone, failed, right? And now what is it doing? It's trying to regenerate back to a downside. Now, when will you know that it quote unquote is regenerating? Well, really, that means it has to actually make a new low. In other words, wherever the retest was off of the push down, right, a regenerate would mean that you'd have to make a new low. And, as you can see from here, we're talking about huge amounts of points, huge percentages. It's unlikely we're going to see anything near that on this first push back down. More than likely, we're going to continue to see some sort of a range. As a matter of fact, if you draw in the ranges that exist, you had this range to begin with, right, which was that 7-month range that took place. And then underneath it, you had kind of another range that had developed, right? And then another one here at the bottom. And matter of fact, I didn't quite get them drawn right. If I were to draw it right, this one would expand. We'd bring this one down a little bit, right? And then it would be about that much, right? Because you want them about equidistant. So what we really did essentially here is we tested back into the top zone on the strongest index. And we tested into it and failed. And that failure happens to coincide, which many times it will, with the bearish retest regenerate. And so we're going to try to push lower. Now, when will we know, that, this is a more significant decline than just as some sort of a, bears selling or bulls selling up here at these highs, just trying to get their money back? Well, we'll know that if we start breaking significant lows. We have, we have one here, and we have another one down here. So those will be the two spots to watch, on the way back. It's like, can you get back underneath, this, well, let's get it in there, right? It's actually there. And then the other one is down here, right? Can you get back underneath those price points? And so that will kind of be, on the strongest index, that will be the areas that we should be looking at on the way back down. If I can get these correct, something like that, right? So this area, that area, that's where we should be focused on the way back when we ask ourselves that question of, are we going to regenerate lower? The NDX looks almost exactly the same. If we move over and look at the sectors, on the sector view, right, there's a couple sectors that actually got a pretty good push up. One is the IBB, But what I'd ask you to do is look at those bearish retest regenerate zones and look what it did, right? It comes into that zone and is unable to get over it. It's no different. And so even here, you're getting the same setup that you got on the general indexes, right? The stronger indexes. Now, there was only a couple that really pushed higher. One was IYT. And if we look at it, that was the bearish retest regenerate zone, and you can see it got over it, stayed over it. So for in my mind on this particular index, right, rather than this now, you really have that, but sector I mean, but even in that case, right, we're not talking about something that's that significant, because if you come over here on the weekly time frame, the bearish retest regenerate here is simply going to try and regenerate lower. So you come to the top of it here, and again here, you get over it, and what happens? You end up underneath it. That's a successful regenerate attempt now to the downside off the bearish retest regenerate, which spanned this large range here, right? So even on the strongest sectors on a short-term time frame, you're actually getting nothing more than some sort of a failure on the intermediate term time frame, or a success, if you want to view it that way, of the retest, the bearish retest regenerate on that zone. And so I want to digress for just a few minutes here and talk about probably the hardest concept in neoclassical TA. And that is you really have two basic things at work all the time. One is you have time frames, right? So you have, on the simplest basis, right, you have three time frames. You have a short-term time frame, an intermediate-term time frame, and a long-term time frame. And for the purposes of a daily, weekly, and monthly chart that we typically look at, those three time frames, they intermingle. The short-term time eventually affects intermediate-term time frames, and which eventually affect long-term time frames. And what I mean is that if enough stocks become negative on this time frame, it eventually will affect, most likely, this time frame. And continuing with that same thought, on the intermediate term time frame, if enough go bad, then eventually you'll see that affected on the long-term time frame. So when you're looking at stocks and you're looking at these time frames, you're also looking to see how are these stocks performing, right, as a group in these three things, which are the sectors, right, the stocks themselves, the sectors, and the general market. So putting these two things together now, if enough stocks on this time frame go bad or get worse or deteriorate or whatever adjective you want to use, they eventually will affect the sectors. And enough of those sectors go bad on this time frame, that will eventually result in a deterioration on the intermediate term time frame for those sectors as well, and of course for the stocks. Again, carrying it one thing farther, if enough stocks and sectors go bad, they will eventually affect the general market. And they will affect the general market on the short-term time frame initially, and then eventually on the immediate term time frame, and then eventually potentially on the long-term time frame, if you just keep carrying that thought forward. So stocks drive sectors, sectors drive markets, and they do it across the three time frames in sequence. If you can get that idea in your head, then you'll have a much better time looking at the market and saying, okay, what's really going on when I'm looking at, at the IYT, and I'm looking at it and I see here on the let's say the daily time frame. Let's bring the daily back up. So I see strength here. If that strength on this time frame lasts long enough, right, then eventually that will affect the intermediate term time frame, and we'll see strength here. But what we have is we have, you know, getting back to trend now. What we have on the intermediate term time frame is this bearish retest regenerate zone that we can use as kind of a precursor to whether this trend that's in effect is going to shift its dynamics to sideways instead of down. It just told us that it's having a hard time doing that on this time frame. And going back to that thought again, if enough stocks in this particular sector do or become more positive for a long enough period of time, and so far that long enough period of time isn't there, it would have to continue to do this even longer to eventually affect the intermediate term time frame on this particular sector. Carrying that thought just a little bit farther, if you get enough of these sectors doing this, improving long enough, then you'll eventually see a change in the general market on, you know, in a more bullish manner, right, on that longer term time frame, in this case intermediate. We don't have that yet. And so when I tell you, and I'm going to go back now to the general markets, so when I say to you, hey, you know, this probably is going to take some period of time for this to play out. When I'm saying that, what I'm saying is that, you know, you've already had the destruction take place. In other words, we've already had this, you know, range that was in effect broken. And then not only did it break, we saw extreme extension to the downside. Now we've had, on a short-term time frame, we've had improvement, right? This thing's been improving. Yet, if you look at the things that make up the general market, i.e. the sectors, enough of those have not improved enough. It's going to, if they're going to, it's going to take more time. And eventually that will affect this, and this will continue higher if that happens. If it doesn't, then we'll see this thing shoot right back down again. Inside that, if you look at, you know, any of the individual stocks inside some of these sectors, you're going to have to see improvement in those. That will improve the sectors, which will eventually improve the market, or vice versa. Those will not improve. The sectors won't improve, and over a long enough period of time, we will see the general market get worse on longer term time frames. And so when we think about longer term time frames, of course, we're talking about the long term time frame, the monthly. That risk that we've talked about is still out there. That's this low and this low. Those are the lows that, if they're broken, we're going to see trend transition on the long term time frame. We haven't seen that for a very long time. Where would it take us back to? Well, just a, you know, just a back of the envelope kind of, you know, let's just do a projection back of the envelope. Take the range that's in effect already and extend that range. If I remove these so we can extend it, if I remove that and then take and extend that range, right, to the downside, where could it take us? Well, it certainly can take us down to test this swing point low. If it breaks to the downside, if you extend it, it takes you back into there, and you can see we're down into the 1550 area. We're still trading, you know, at what, 1900 or something, right? I mean, right now we're at 1958. 1550 is 400 points lower. That's a long way. Projection initially would take us to this swing point low. I would expect you'd get some sort of bounce out of there. And then, you know, from that, you know, if this plays to the downside, you break this one, extend to this one. You get some sort of a bounce out of that, and then a farther extension that takes you down into this 1500 number we were just talking about, 1550. That's the way this probably will play out to the downside if it's going that way. It's a little too early to assume that. Why? Because, well, it's going to take time, most likely, right? This thing, the first clues are going to be the breaks of swing point lows all the way back down. So we're going to break this one and break that one and test that. That's the first clue. We have volume off the top now, so now we have the potential to come down and break, and that will be the test this week. That's what we'll be looking at to give us clues as to whether, this bounce is done. So to continue on here, technically the positives, it's hard to find positives in what happened. It was a sideways week. And the bearish retest regenerate on the stronger indexes, it only got to the first half of the sequence. So in other words, if I pull up the NASDAQ, let's go back to that one. If I pull up the NASDAQ, right, that retest regenerate. So when we came up here to do this retest, all we have so far is we have the failure to get above the high. To regenerate lower means we have to break the lows. And as I said, that's a long way down. So right now, all we have is half of the sequence taking place, and that is the failure to get over the highs, right, which sets up the potential now to go break the lows. But given the extent of the damage, breaking the lows is not going to be easy. It's probably, assuming, let's just assume that we made the highs on the bounce, we're not going to make any more. How would we break this low? Well, most likely you're going to see some sort of a trade down to here, some sort of a bounce, setting up ABCD structures, to eventually get us down to this area and not be so extended by the time we get there to actually break it. The most bullish case, on a pushback down would be just a straight move back down to test. Get under it, not have any volume, and then you get a nice bounce out of it. That'd probably be the most bullish case if we go straight down from here. But, I suspect more likely you're going to see something, where you're going down, you're going up, you're slowly working your way down versus, back up. And then eventually, by the time you get here, right, then you can actually break this thing. So, to me, that's the way it would probably play out if it's going to play out that way. So I think it's probably a little early to expect this technical breakdown on the longer term time frame. There's still the potential now for some sort of a long drawn out, scenario. I've talked about that before where, if we look at it on the weekly time frame, we'll pull up and we'll just keep using the NASDAQ. The more likely scenario, I don't know if it's more likely, but a scenario that we could certainly envision is that this thing could play out for a very long period of time in this range. It doesn't have to get all the way back up here, although it could, and it doesn't have to break these lows, although that could happen. The more likely scenario probably is that we're going to see this thing trade inside this range for some period of time still, right? It's not going to, it's not going to break out of the top and it's not going to break out of the bottom until enough time has probably passed. So that's that. And then sectors, there's a little relative strength, but nothing. I already talked about that. On the negative side, the fact that these things have confirmed that there's sellers up there is bad. We suspected that would be true. Everybody wants to break even. And so anybody, let's go back not to the monthly, but to the daily or weekly even, anybody that was in this, if you go back and you just think about where have people bought this market, anybody that bought in this time frame, which is pretty much all year long, right? They were underwater. This allowed them to get out. This bar allowed them to get out. And that's what we saw, right? We saw people selling to get out, quote unquote, at even or some sort of a small loss. My suspicion, usually in these cases, my suspicion is that anyone that has bought from here up is still underwater and still hoping. The people that we saw just sell were those that bought in this little range on this breakout. What we're going to see if we come back down again, right, if we start to see this decline, we're probably going to see anyone that bought this range start selling, which could push us lower. In other words, they're still thinking they can make money, but if it starts to give up, they're going to get out. And then that takes care of anybody back from December through I think February. At that point, all the natural sellers, except for the folks that are stuck in this thing, right, which is everybody up here, or the majority of them are going to have left the market. Then you're going to simply have the people that are in this range, right, that are still holding and still positive, right? And then they only become an issue if you break down farther, right? Then they become the sellers on the way back up. And you can see how that can lead to larger moves, right, to the downside. You take out one set, you get a bounce, they sell into it to get even, which leads you lower, blah, blah, blah. That's kind of how the market typically moves. So, for me, that is kind of what's going on. If I look at the huge volume on Friday, going back here to the daily, this huge spike in volume is a negative. That can be viewed, in my terminology, I call it volume off the top. So you make a top and then you get volume off that top. That's a very bad situation. Looking at the weeklies, right, every one of them, and what I just showed you here, again, I'll use the NASDAQ as the demonstration. Every one of these stocks now, save the Russell, and the Russell barely just didn't do it. This big bar down, right, this is the wide price spread, high volume bar to the downside. Every index now on this time frame went over, back under, right, and failed. They failed to hold that high over that high volume, wide price spread lows high. In other words, they got over it, they got under it, now they're ready to try to come back down. And in every one of these cases now, you can draw in potential ABCD structures to take you lower. And so if I draw them in, if I can draw them in, let me see, this one comes to about here, right? That is the way these things look now, which would do what? It would test these lows, potentially get underneath them, October lows of last year on the strongest of the indexes, in this case the NASDAQ. Those structures are slowly setting up. And I suspect, as I said earlier, that the way this will happen, if it's going to happen, is you'll get some sort of a move down, some sort of a bounce, off of that, right? And then another nested ABCD structure and so forth until you get down and break them. So that's the way that is setting up, and that's what I'm talking about. The other big negative out here right now, that's a direct result of what the Fed did, is the financials, right? The financials have failed miserably now to even get back to do the bearish retest regenerate. And they've been unable to truly get over and hold over the high of that low, that big spike low. And they already are threatening the only low that exists, right? And they'll be doing it probably tomorrow. A break of this low that gets you deeper in, right, to this zone down here is going to be very negative because it's such a large weighting in the S&P 500. So if I'm looking at a negative sector and I want to focus on how it behaves, the financials is the one to look at. As a matter of fact, if I do some shorting this week, it will be on the financials. So that to me is a huge negative and is a direct result of what the Fed did. So worldwide, we have these bearish retest regenerate sequences just as well. If you look at Europe, they look almost exactly the same as us. Asia is a little bit farther along because they started falling sooner than everybody else. So they have a little bit more of a bounce going, and they fell farther than everybody else in terms of percentages. It appears to me they're getting up towards the areas that they too should start to fail. So, I see that probably as a negative too. Fundamentally, it's hard to find any, fundamentals that are positive. I think the most positive thing out there right now is just the U.S. economy in general, especially on the consumer spending side, really hasn't started to falter significantly. In manufacturing, yes, it has. You see it in all the numbers that keep coming out, but that's probably the only real positive out there right now. We could say that, the Earnings are not that bad, and I guess we could have put that as a positive as well. Those will be tested soon because earnings will be the next thing that comes up. If you look on the negative side, man, there's plenty. There's the geopolitical. There's the the fact that every country cannot get out of ZERP. If you remember, England supposedly was going to do it, unable to do it. Now we try to do it, unable to do it. These deflationary forces, they continue. They're everywhere. And if I think about, most of the economic reports I see, almost every one of them is decelerating growth pretty much around the world. If I had to point to something, I think I've talked about this before, I would have to say the internet is arguably the most disruptive technology we've ever witnessed. And it's a deflationary invention, right? Because now you can essentially get rid of the middleman in so many cases. You think about real estate. It's very disruptive to that model. More and more people are listing their own homes for sale. You don't need a broker to list your home. You can just list it on the MLS like anybody else. You can pay a $500 fee, and you can have your home in a place that most people can find it, both on the internet and on the MLS. You don't need a listing agent. You can get the paperwork. You can do everything for yourself for like $1,000. Why would you want to pay 3.2% to someone? You got $1 million home, 3.2%, $32,000. I can list it for $1,000. Why would I throw $31,000 away? Disruptive. Look at Amazon. Look at so many of the industries. Look at where we're going. Healthcare, going to have the same problems. Education, same problems. Disruptive, deflationary. Most disruptive, deflationary invention we've ever seen. It comes at a time where we have price deflation everywhere and everybody is struggling with debt, huge amounts of debt. Inflation is a problem. If you're not inflating your debt away, debt is a problem. And that's what we're facing everywhere. It continues to be a problem, and I don't know how it gets resolved because you can't, quote unquote, inflate it away. Debt is cumulative debt is a real issue if you can't deflate it away. And right now, or excuse me, inflate it away. Right now we have deflation, and we can't seem to get rid of it. Central banks are trying their best to get rid of it, and they can't. So to me, those are the negatives, and that's a big negative, and just something worth pointing out. What to watch? Last week we were looking at the Fed. We were thinking about options expiration, exasperated move, right? Exaggerated move as a result of that. That's what we got on Friday. If I look at next week, at a minimum, right, the seller should be able to break these swing point lows. So if I go back over to the S&P 500, it would be a feather in the cap of the bulls if they could not break these lows, especially the top one. They may not get the bottom one this week, but certainly that top one. If the bears, the sellers, cannot overtake that swing point low and sell at lower and lower prices, right, then that would tell us that this range definitely is going to hold for a while. If they start breaking these out, well, then you put the bottom one on the target again. So, to me, that's the key thing to watch this week. And you get a test immediately, probably, on this one, right? This is not that far away now. I suspect that's going to be the first test somewhere in the first 2 days, maybe 3 days of the week. If that holds, then that's very bullish, if you can hold it this week. If it does, especially given this week being the last week of September, which is historically horrible. So that would be what I would be watching this week. Earnings, economics, earnings about 3 weeks out. Economics, there's some PMI numbers this week. You got Fed speakers every day this week. Lockhart, for some reason, is speaking like 3 days in a row. I guess the guy's got a lot to say. You got Yellen on Thursday. Those will be the big things this week. What's the bottom line? Last week I was expecting some sort of a larger move off the Fed. As I expressed to you, thought they would raise rates. Yellen would soothe the market, and we would actually see a continuation of that bounce. Didn't happen. Sometimes you can envision these things and they play out. Sometimes they don't. You got to be ready to move in either direction. Unfortunately, it didn't work out the way I was wanting and trying to bet on. And, that's the way it is. So you pick up the pieces and you move on. This week, there's a lack of news. And unless we get some sort of Fed speak, I'm not sure how this market is going to be able to move higher. Technically, it looks like it's going to try to move lower. The only real question in my mind is not does it move lower, but how much lower does it move. If we look at the portfolio, I played just like I was alluding to just a second ago. I played the SPY on a breakout, thinking we get that Fed continuation, we get over that swing point low. I was probably naive thinking that we could on the NASDAQ and the NDX. That was the NASDAQ's first test of that swing point low. Probabilities are high that it would regenerate lower. I didn't take that into full effect. I guess I was a little bit more optimistic than I should have been. So now I'm in a bad position on the SPY. Going to have to try to take that out somewhere. ITB, relative strength still there. Unfortunately, the general markets are going to be weak. That's going to play against it. That's not going to go anywhere. The gold stocks, of course, bounced up last week. That helped the DGZ to come down as gold itself moved higher. DGZ, it's about time to probably buy back into that. This trade, I don't know if you're watching it carefully, but this trade is really starting to work out, and I suspect it's going to continue. And if anything, I'm going to try to make it larger because we're getting dividends on the GLDI, right? And pretty good dividends at that. And we're able to spec short against it with the DGZ and make money. So that's, to me, if you can't make money on the long side, and it's a little dangerous to try to play the downside, then you want some sort of a good spread trade to work in between where you don't have much risk. And you can just keep playing it for some sort of gains. Euro, I suspect eventually is going to go lower, but again, if we look at the euro itself, and let me pull up FXE here. If we look at the euro itself, right, we had a big spike up off the Fed news, but then you had a takeaway bar the very next day. That is the first clue that this dollar is not going to go sailing back to the downside, that these other currencies are going to continue to be under pressure. That's probably going to put pressure back on the commodities, and that's probably going to continue to put pressure on the equity markets as the dollar rises. That trade, the euro, is going to work lower over time. There is some risk, which is what I've been watching for, that this thing could come back into the 118 area, right? So in other words, this area up here, it could have traded back to, and so I was kind of, hedging. You actually got volume here on the test of these swing point highs, even though it failed. You can come back and test that area. So I'm a little, shy, shall I say, to go and spec more of this right now. But at some point, I think that's going to be an even better trade. Just got to find a spot to do it. Looking at the two stocks that we continue to trade, SBUCs and ZLTQ, those two stocks continue to act very well. There's absolutely nothing wrong with either one of them. The only thing is they're playing in a market that is weighted down by the Fed. Here's SBUCs. You can see how it's traded higher. And ZLTQ, same sort of thing. I like both of these. Weakness, we should buy them. HEDJ, totally different story. The strength in the euro plays against this when it's going up. When it's coming down, it plays into the hedge. I don't know if it's going to blow out these lows. This swing point low is the key low. If we get underneath that, we're probably going to go test those lows, and we're not going to be around to see what happens next. So I've got one stop underneath here, one stop underneath here. We'll have to take the part of this out if it starts to break down, and just continue to trade by what we see here. So that's and in the sectors, I've got the sectors here for you to see if I can pull those up. These sectors, strong and weak. There's a few strong sectors, but for the most part, everything's pretty weak. We're not in a historically good period of time. September is a tough week, a tough month. Last of September is very tough. Then you come into earnings, and that can be either up or down. Earnings this quarter should be benefited by the dollar not going anywhere. The takeaway is that overseas sales are not going to be that strong, and even domestically they're not going to be that high either. So it's going to be key for those earnings for them to continue to financial engineer those earnings, because I don't think the sales, the revenue side is going to rise. So we'll have to see how those first sets of earnings go. And unfortunately, banks are going to be the first, as always, the stronger banks. And I don't think those banks are going to show good. I suspect earnings are going to be sold, especially if we lift into earnings season. So let's keep that on our radar and think about how to play that when it gets time. That's it for this week. Hopefully that helps. I will I'll be around to help you as always. If I can help you individually, let me know, and I'll see you next time.